Did you know that over 90% of life insurance policies lapse or are surrendered without the policyholder realizing they could have swapped their policy tax-free? It's called a 1035 life insurance exchange. I'm going to explain who can be involved in a 1035 life insurance exchange, what products can be swapped, and what you have to do to make sure that the exchange is tax-free. Now, I'm not giving you tax or legal advice. I'm just trying to share what needs to be done in a 1035 life insurance exchange to make sure that it's tax-free. Normally, life insurance earns interest, which increases its cash value. You may have noticed that you never include this interest in your taxable income. Well, that's true only if the money isn't taken out while you are still alive. Technically, swapping one insurance policy for another insurance policy is taking money out while you're still alive. This is where a 1035 life insurance exchange comes in. You can exchange one insurance policy for another and you won't have to pay taxes on it, even if you have a gain. You can do a 1035 life insurance exchange with the same insurance company or with a different insurance company. You do have to follow very specific procedures though. We will go over the procedures in detail a little later, but first I want to explain the tax consequences if you don't follow the 1035 exchange procedures. If you make withdrawals from your life insurance while you are alive, you won't be taxed up to the amount of money that you have invested in the policy. The amount that you have invested is called your basis. After you run out of basis, your gain would be taxed. If your insurance policy has been deemed to be a modified endowment contract for tax purposes, it will be taxed differently. Any gain would be taxed first. After you run out of gain, then any remaining amount would be tax-free. Also, if you're age 59 and a half and you withdraw money from a modified endowment contract, you may have to pay an additional 10% federal tax penalty. By the way, if you exchange a modified endowment contract for another life insurance policy, the new life insurance policy would be a modified endowment contract. We're going to go through the steps required to make sure that you have a life insurance exchange that's tax-free. But first, let's break down the 3 required conditions. Condition number 1 is what can be exchanged. You can only exchange a life insurance contract into one of the following 4 contracts: another life insurance contract, an annuity contract, an endowment insurance contract, or a qualified long-term care insurance contract. You cannot exchange one life insurance policy into multiple contracts. If you're transferring your life insurance into a long-term care contract, you can transfer into a standalone long-term care contract or into a life insurance policy that has a long-term care policy rider. There's a gray area in the tax code that doesn't state whether you can exchange permanent life insurance for term life insurance. If you want to exchange permanent life for term life, you should ask the insurance company first to see if they are willing to do that type of exchange. The second condition details who can be involved in the exchange. To meet this requirement, all of the same insureds must be on both the original policy and the new contract. The exchange cannot transfer ownership to a non-U.S. citizen. If you exchange life insurance for an annuity, the same person has to own the life insurance and the annuity. The third requirement for a tax-free 1035 life insurance exchange is you have to follow a specific process. The process has to be set up in a way to make sure that the owner of the policy never touches the money or cash value from the life insurance policy. So you should never surrender the policy yourself. You will have to assign the policy to the insurance company who will be issuing the new contract. The new insurance company will surrender the old policy after they take ownership of it and after they issue the new contract to you. If you aren't able to get your new insurance, the exchange will terminate and you will get your original life insurance policy back. Now, having a loan on your life insurance policy can complicate things just a bit, but I will go over that in a moment and give you an example of how it would affect an exchange. But right now, let's go through the detailed steps that need to happen so you can avoid paying taxes when you transfer your life insurance to another contract. There are 8 steps in a 1035 life insurance exchange. You will have to do the first 3 steps, and the new insurance company will do the last 5 steps. You can use the same insurance company for your old and new contracts, but to make things simple, I'm just going to say new insurance company in these steps. Okay, so step 1, you will submit an application for one of the products allowed in a 1035 life insurance exchange. You will indicate on your application that the purchase is part of a 1035 exchange. Step 2, you will assign all rights to the original contract to the new insurance company. The assignment form will have wording similar to what's on your screen. In step 3, you will give the following documents to the new insurance company: the signed application, the signed absolute assignment form, the unsigned surrender form, and the original insurance contract. Step 4. The new insurance company will sign the assignment and surrender forms, but will hold on to them until the replacement contract is issued. Step 5. The new insurance company will underwrite and issue your replacement contract. Step 6. The new insurance company will use the pre-signed assignment and surrender forms and will surrender your original contract to the original insurance company. They will include a memo to let the original insurance company know that it's part of a 1035 life insurance exchange. Step 7. After loads and fees, the new insurance company will credit the new contract with the cash surrender value from the original contract. And lastly, the new insurance company will use Form 1099-R to report the transaction to you, the original insurance company, and to the IRS. As long as all of these steps are followed, your 1035 life insurance exchange should be tax-free. As I mentioned earlier, a loan will affect your exchange. If you have a loan on your life insurance policy and you want to avoid paying taxes, you will have to repay the loan in cash before you exchange the policy, or the new insurance company will have to carry over the loan amount from the original policy to the new policy. If you don't do one of these two options, the loan will be counted as a withdrawal. The loan amount will be reported on Form 1099-R. Let's look at an example of how an unpaid loan on your life insurance would be taxed. We will say that your original life insurance policy has a cash value of $50,000, and after paying premiums and receiving some dividends, your basis in the policy is $30,000. This means that you have a gain of $20,000. Let's also say that you have a $5,000 loan on the policy. You decide to have the loan discharged instead of paying it or doing a carryover to the new policy. So the cash value of your new policy will be $45,000 instead of $50,000. You will pay federal taxes on the discharged loan of $5,000, but you won't pay taxes on the gain of $20,000. If this video was helpful at all, please leave the word helpful in the comments section. Also, if you're looking for other ways to avoid federal taxes, please watch the video in the upper left of your screen. All the best to you.